Welcome and thank you for joining HCM's call with Doug Johnson and Mike Hengehold. Doug and Mike will discuss the economic developments from the last week, the market activity over the last week, and will address specific client questions that have come in. And with that, I will turn this over to Mike Hengehold and Doug Johnson. Mike?
So welcome everybody. This is another in our series of weekly calls to keep you up to date on what's happening in this whole sort of stimulus program world and what we're doing from a planning perspective regarding those changes, and also how we're handling it with the portfolios. The first thing I'd like to do is start with a positive focus, though. Even in the midst of all these scary times, there are still good things that are happening. Here at HCM, believe it or not, we added a new team member this week. We added her virtually. Cassidy Harrison joined our operations group this past Monday. Another positive is that our politicians seem to be pulling together in the same direction to get Americans that are affected by all the COVID crisis to where they were before this whole mess started. And again, one of our regular shout outs is we would like to recognize all those working hard to meet our healthcare needs and all of our basic stay-at-home needs so that we can be successful with our sort of quarantine efforts as we try and keep our social distance. You know, goal setting has been one of my regular practices for as long as I can remember, and one part of that process has always been to develop a specific actionable plan for the 90 days right in front of me. Nothing groundbreaking there. That's just essentially a rolling quarterly game plan. But as a result of that, fortunately, HCM has had disaster plans in place, which allowed us to step into remote capabilities pretty much immediately before social distancing even became a thing. And as a result of that, we've been able to stay focused on our rolling 90-day game plan through all the recent turmoil. Now, a benefit of that is that this rolling planning allows us to quickly refocus our priorities as things change. And with the CARES Act that was passed really just a week ago, we have a boatload of new priorities that we're focusing on. And what we're trying to do here is help our clients make the best use of all the various stimulus programs that are going to be made available. There are a lot of planning opportunities here for people to take advantage of, and others simply need the help. And we want to make sure we're there to help people make the best decisions that we can. Jake and I were talking yesterday, and he said it seems like we are going into a perpetual mode of tax planning this year. And I think that's right. Most of the opportunities that are going to come out of these stimulus programs are going to have a particular tax advantage, or they're going to create tax opportunities. So everything here is tax related one way or another. Fortunately, we are pretty uniquely positioned to be able to help you make good tax decisions because we've got, of course, the CPA firm, and all of our advisors are pretty tax savvy in that regard. The first thing that I want to touch on briefly that we're dealing with all of our clients that have businesses of any sort have to do with these tax-free grants that are being made available through the Forgivable Loan Program known as the Payroll Protection Program. All of the banks are being overrun with requests for loans, and basically these loans are going to allow people to get a multiple 2.5 times their average payroll burden in order to help keep employees associated with the company. The politicians have decided, and the policymakers have decided, that restarting the economy will be much, much easier if employees still have a relationship with their company rather than getting benefits to these people through the unemployment system. So they're really bending over backwards to keep that employer-employee relationship intact. We are reaching out to everybody that we can think of who we think might be eligible for these programs. So if you haven't heard from us, you will. However, if you have any questions whatsoever, please feel free to reach out to us. We can help you get the information together, get ready to make your application to the bank for these programs. There's one other item I want to touch on, but I'll do that in a minute. Right now, Doug Johnson, HCM's Director of Portfolio Management, is going to give us a bit of a summary of what's going on over the last week or so, and also what HCM is doing. Doug?
Yeah, thanks, Mike. Yeah, so first thing, some minor portfolio talking points. So earlier this week, we made a position change based on our outlook of pretty recessionary type growth going forward. We took a look at portfolio positions and kind of looked at what we thought wouldn't perform well in that environment and what we thought would. So we have sold our equal weight S&P 500 index ETF, which is essentially a broad market index, and replaced it with the Spider Consumer Staples ETF. So the Consumer Staples ETF consists of companies that we believe will still be able to drive demand for their products in both a recessionary environment and or a continued lockdown. So you're probably familiar with a lot of these names, the P&Gs of the world, the Costcos, the Walmarts, the Krogers, basically companies that make things that people still need. Throughout all this, staying at home, I've noticed personally that my spending has gone down in a lot of different places, but it certainly hasn't gone down in the areas of buying groceries and essential items. So we feel like that small position change should benefit us based on our outlook going forward. And then we've also used this recent rally as an opportunity to rebalance some of our tactical portfolios back to model weights. So, using this equity strength as a way to sell off some of those gains and move them back over to the fixed income side of the portfolio. So if anybody has any further questions about those trades, please reach out to your advisor and we can get those answered. So now on to market and economic data. So it's been kind of another crazy week in the market. There seems to be this kind of cognitive dissonance going on right now, and really that term it's a psychology term, but it's often used in behavioral finance to describe this I guess conflict between two scenarios that seem to be at odds with each other, and what you're seeing right now is economic numbers that are truly unprecedented, almost depressionary level numbers, versus a market that seems to, for lack of a better term, not care at all. We had a good rally to start the week on the back of what was termed as optimism surrounding caseloads, deaths, new cases, etc. Though I read an interesting study on some of this data that was suggesting that there's actually some seasonality in the reporting. Now, all that means is that on different days of the week, you can get a drop and or rise in cases from the week before. So Sunday and Monday, ironically, have been found to always have the most optimistic data. The conclusion was simply that there's not a lot of tests going on Saturdays and Sundays. So when we come into Monday, it seems like the last 3 Mondays we've gotten really optimistic news about the case numbers, and that's caused some rallies in the market. So we had a strong rally on Monday, followed yesterday with another one that sold off at the end of the day, but it seemed like most of that was made back today. So this isn't necessarily surprising market action. I mean, we've been talking for for the past 2 weeks about kind of how bear markets normally operate, how there's normally a reflexive rally after this big steep drop, and we're seeing that right now. It's probably been a little quicker and steeper than most would have expected, but I don't think that there's anything right now that would lead us to believe that the all clear flag has been waved. Because on the other side of this, what you see, with the economic data, so there'll be another initial claims number tomorrow morning, but the last two have been 3.3 million, and then the one last week was 6.8. So you've had 10 million initial unemployment claims over the past 2 weeks. To give you some perspective, the highest number that we've had in history before this, I believe, was in the early 80s. And was right around 695,000. So last week we're almost at a factor 10 times higher than that. In addition, you've got a non-farm payroll last week that came out. In a good economy, those will run anywhere from 100 to 200,000 jobs added. This one had 700,000 jobs lost. So you're starting to see the economic impact of essentially shutting the economy down for the foreseeable future, and it's starting to flow through. The other kind of thought I've been having over the past few days is we've gotten a little bit more optimistic about the fact that we've reached the peak in cases, so to speak. It seems that if we've been doing something, quarantining essentially, for 4 weeks now, and we're just starting to see the effects of that, it wouldn't make a whole lot of sense from my perspective for us to then go and say, all right, well, we can stop doing this now, when it's taken so long just to be effective in the first place. So I think there's a lot of optimism surrounding what the other side of this is going to look like. And I feel like there's been a lot of focus recently on just the medical information. And we've kind of pushed the economic data to the side a little bit. And it feels like once that peak passes and the medical data kind of takes a back seat a little bit, then we're going to have to stare the economic data right in the face. And we've had approximately 13 recessions since the Great Depression, and all of them have existed outside of the constructs of a virus shutting down the economy. And I think a lot of people are looking at the fact and saying, well, once the virus is gone, we'll just go back to business as usual. If it was that easy to just restart an economy, then we would essentially never have a recession because we could just do that all the time. It's more akin to driving an aircraft carrier when, you can't just turn on a dime. It takes time to navigate through these things. So, our concern remains that the economic impact of this is still not fully understood, quite frankly, and we simply don't know what the depth and or duration of I think it's fair to say the recession that we're either in or going to be in is going to last. And until we can put some certainty around that, we don't see a whole lot of reasons to move off of the defensive positioning that we've established. And for the time being, we will continue to use any kind of market strength in order to rebalance portfolios and make sure that we're as close to our targets as we can be. So with that, I'll throw it back to you, Mike.
All righty. What I would add just on top of what Doug is saying, I don't want anybody to misinterpret. We go to great lengths to make sure everybody understands we don't really predict the market. However, we go to great lengths to manage the risk in our portfolios. Maybe the difference between those two things may be a little blurred, but when you look at the consequences of an economy that nobody can predict, but we just know it's going to be bad. The only question is how bad. That's being met with the sort of the other force, which is the central banks around the world saying they're going to print as much money as they need in order to solve the problem. We have lots of models for these things in the past, different levels of stimulus, but oftentimes, in fact, most times, we see this is what Doug was alluding to before, with sort of the reflexive rally in the middle of the bear. Even when the stimulus is known, there's oftentimes pretty difficult markets that follow when the economic news starts to become a reality. That's a risk that we feel we need to protect against. So that's sort of what's behind this defensive posturing. There is one other planning item that I wanted to touch on today. We mentioned it briefly last week when we were going through more details of the CARES Act that had just been released. But this is something that's going to affect probably every HCM client, either directly or indirectly, and it has to do with the waiver of the required minimum distributions for this year. So if you are subject to required minimum distributions, you know the term RMD very well, and you've been living with it, you know what that is. But if you, pardon me, if you have parents, if you're not either 70 and a half or 72, because those rules changed this year, but if you're not in an RMD mode, but if you have parents who are, then there's a good chance this is a decision / opportunity that you're going to have to deal with, and you may wind up helping them in doing that. So what I want to do is just lay out what this change is and where the opportunities lie. So the RMD is the required distribution. Required minimum distribution is what RMD stands for, and essentially what this is the government has allowed people to accumulate money tax-free in their retirement plans for all of their working lives. And when you get to the magical age, used to be 70 and a half, now it's 72, they want their money. And the way they get their money is to force a gradual liquidation, to force gradual distributions from. They don't force you to liquidate it. You don't have to spend the money, but you do need to take it out of the plan. And that triggers a taxable event. And retirees face this, and these RMDs happen every year of their life. Because these are taxable distributions, they can force people into higher tax brackets. They can force people to pay higher Medicare taxes and other things that are related to tax rates or levels of adjusted gross income and so forth. So it's very much a tax planning opportunity. This year, the RMDs are waived, and so that means if you or your parents, but that those payments no longer have to be taken. That means now from a tax planning perspective, there's a big hole in your tax return that's going to mean either lower taxable income or the opportunity to fill up those tax brackets in a meaningful way with other things that can provide a benefit. The number one favorite here are Roth IRA conversions. So that's one of the big things we're looking at. However, a number of people, so that's one planning opportunity. Something to be aware of is that many people use their IRA distributions at the end of the year in order to pay their federal income tax through withholding. These people may need to make estimated tax payments beginning as early as June 15th if they're not going to be taking RMDs. So that's another tax consideration. But the big thing, again, we're looking for are the Roth conversions. Another issue that's come up already is some people take their IRA distributions, their required distributions, very early in the year just to get them out of the way. Well, right now, if you've taken that distribution within the last 60 days, you can go ahead and simply put it back under there are rollover provisions which would allow you to basically squash that taxable income. There are some technical requirements. If you want to do that, talk to us or talk to your CPA to make sure you meet them, but it's a pretty straightforward process as long as you haven't done it within the last year. Since we're more than 60 days into the tax year, though, if somebody did this right away early in the year, then putting that money back right now is prohibited by statute. We expect the service to put a broad waiver in, but to this point that has not happened. So that's something you'd want to pay close attention to if you've already taken that money. If you take your IRA distributions every month, then we might want to talk about stopping that and sourcing money from other places. Of course, you're still allowed to take your IRA distributions. Some people, that's all they have is their IRA, and all their money is wound up there, and that's where they get their spending money from. So that's certainly permissible. There are other opportunities that may come up, we'll talk about more in future weeks, that give you the ability to manipulate your IRA through loans and so forth that may help with that, but I don't want to get too far into the weeds on that today. So basically, it is to be aware of these RMD rules that they've been waived. It creates a great opportunity either for you or I'm sure somebody you know, and it would be a terrible thing to just let that go by without using some of these planning opportunities. That's the last thing I wanted to touch on planning. The other thing, we do have some questions that came in again this week, so we want to address those as well to the extent we have time, which I think we will. So the first one, I'll take. It's an easy one. I like the easy ones. The question is, I haven't heard any of the news reports about the $1,200 stimulus payments, which should be arriving soon, specifically as to whether or not these are going to be taxable income in 2020. Any idea whether or not it's taxable or tax-free? This is a good answer. The $1,200 payments that are coming in are going to be tax-free. So it is actually, we went into a little more detail last week on how they're delivered and so forth, and how you qualify. There is some planning here. If you are going to be outside of the qualification zone, you may be able to do some planning, especially with these RMDs being waived, that would allow you to capture these stimulus payments when you file your tax return later next year. So if you think you're going to be out of the zone but would like to look at planning options to capture them, give us a call. Next question, Doug, I'll let you have this one. How fast will the economy recover when the quarantine is over and we're back to normal?
Well, I think that on the best case scenario and the one that everyone is hoping for, you will get what is called a V-shaped recovery. The name obviously implies the letter because of the shape that it produces, which is essentially a sharp contraction in growth in the first half of this year, followed by a kind of explosion of growth in the second half of the year. Again, I don't know that how realistic that really is, considering all the things that we talked about, considering the amount of jobs that have been lost, and considering the fact that the whole construct of what's going on here and the demand destruction, it's going to take some time to get that started, simply because absent a vaccine or a cure, there's certainly going to be behavioral modifications for that. Would you want to sit on a crowded airplane? Would you want to go to a crowded restaurant? Would you want to go to a sporting event and sit next to somebody if you were concerned, or if you were an at-risk individual and you were possibly going to contract the virus? So I think outside of that, the V-shape is a little bit less likely. I think what we will probably see is something more, and I'm going to steal this letter from Liz Ann Saunders, who's a market strategist at Charles Schwab. She could refer to it as a Y, where you get a steep contraction get an initial pop up, but then you get a flattening out to where things just kind of taper off a little bit. And if you remember back to 2008, coming out of the great financial crisis, we had a very strong market response, and initially we had a pretty strong economic response, but then it also leveled off. You've had what was the longest expansion in history over 10 years, but it was also one of the weakest in terms of growth percentages. So I think we're probably more in line with that than the V, but I think everybody's optimistic and hopeful that we get the V, and if we do, that'll certainly be a best case scenario.
Okay, I think we have time maybe for one more. I've heard this one is a popular question. I've had a lot of people ask me, how will our country get out of this? A country can't give away this much money and not have a problem for generations to come. If they just start printing money, won't inflation take over like it did in Germany in the 20s after World War I?
Wow, this is a lot to unpack in 2 minutes, so I'll do my best here. So I think, yes, there is a significant concern that at some point all of this stimulus, the deficits will eventually lead to some kind of inflationary pressures. I think the issue right now is there's still a lot of leverage in the system, and a lot of it is probably unproductive leverage. So that is certainly a deflationary force that's kind of fighting against any inflationary forces that we would get. So I think until that leverage clears out of the system and the stimulus is maintained, that inflationary pressure is probably down the road a little bit of ways, but it certainly should be a concern, though in times like this when we feel like we need these emergency measures just to essentially prevent the market from falling apart, we're kind of willing to look past that, possibly to our detriment. But yeah, I think it will start to be a bigger concern as we move forward in this. The German situation, I think, is a little bit unique in the sense that they had very specific problems, mainly that they had a massive amount of debt that they needed to repay from war reparations, and it was owed in a currency that was not theirs. So they couldn't simply just print more money to pay this back. The more money they printed to buy their currencies, it caused their currencies to hyperinflate. And there's actually a really, really good book called The Lords of Finance that goes into great detail about that whole situation. And I know since everybody's at home doing nothing, they could certainly pick up a copy and read it if you're so interested.
Okay. Well, that does it for our 30 minutes. I hope everybody enjoyed it. I want to say thank you to everybody for participating. Again, Doug and I are thrilled. We're getting over 100 people calling in pretty much every week. And so we'll keep doing that as long as there's something newsworthy to cover. And I think that'll do it. So thanks, everybody. We'll look forward to talking to you again soon. Bye-bye.